Hello everyone, this is Jordan. This video is being recorded on the very early morning of Monday, August 19th, 2024. Thank you so much for joining me. Hope you all had a great weekend. And in this edition of Macro Mondays, this solo edition, I should say, going to talk about the Fed and rate cuts and possibilities for the stock market, and also the fact that gold and gold stocks appear to be reacting to the coming Fed easing. So I only have 3 charts. This shouldn't take too long, so let me get right to it. Okay, so here's a macro chart. This doesn't have as many data series on here as I usually have because I wanted to focus on the stock market. So here we have the Fed funds stock market. Here's the yield curve. Here's gold divided by the S&P. And the vertical blue lines, these are points when the Fed started cutting rates. So we're going back about 40 years after the double dip recession, after the double dip recession in the very early 80s, or at the start of the 80s. That's kind of difficult to say, as you can hear, I should say. So yeah, the vertical lines, that's when the Fed started cutting rates. And usually when the Fed starts cutting rates, especially when you're not in a real inflationary period like we were in the late 60s until 1980, 81. Putting that aside, there's 3 ways that the stock market can react. So first is the Fed's cutting rates because things are about to start falling apart. The second is you get basically a soft landing. So they cut rates and you're set up for a soft landing. The other side is they cut rates and then the market rallies a little bit before you actually get the recession and the bear market. So going back, again, 40 years, there are examples of all 3 of those. So we look here, the soft landings were in the mid-80s, in the mid-90s. This also was potentially a soft landing, although I remember reading something that we were headed for a recession. Some people were saying that at the end of 2019. So maybe it was the impact of COVID in China. So I don't know if you could completely throw that out. That was before COVID hit our shores. So yeah, in a way, this was kind of a soft landing, but it was short-lived. So okay, so the mid-80s and mid-90s, those were soft landings. And you can see here the yield curve. I mean, this steepened, but then it steepened for a little while, but that was it. Mid-90s, the yield curve, it started to steepen before, but it really didn't do much. So if we are going to have a soft landing here, yes, the curve can uninvert, but it uninverts, but it doesn't shoot up to here. Maybe it uninverts and it just kind of goes like this, and it doesn't really do that much, or steepen significantly, I should say. So that's one possibility. Now you look at the other cases. This was an example of things falling apart. Or actually, I should say 2008. That's when they cut aggressively in September. I mean, they started cutting in August 2007. Well, I guess when things started falling apart, but I'm kind of contradicting myself here. But the market, they cut in August. I remember that in the summer. And the market kept running until I think it peaked in November. And so you go back to the market decline at the beginning of 2008. Then I think you had a rally for a little while here. I mean, so the market was lower, but my point is they cut in August and the market kept running for another 2 months. And if you think about it, there were a lot of sectors that were still moving into 2008 because the banks and housing were just dragging the market down significantly. But commodities and emerging markets, they didn't peak until March 2008 or the middle of 2008. The Fed cuts and you still get a rally. This also happened in the 87 to 90 period, which is a little unusual as well, where the Fed started cutting here in 89, and then the market didn't peak until, you could say potentially here at the beginning of 1990 or right here. I think it was right here where this is a bit of a marginal high. So again, the Fed started cutting here, and it took a while for the bear market and the recession. So it can kind of postpone it for a little while. Okay, here's another case, 2001, where yes, things were starting to fall apart and they cut because the market had this big move down, the tech crash. So That's why they started cutting. And then the recession came after that. So I'm just going through here. There's three ways it can go. And so basically, with respect to gold, I've said this before, how much this curve steepens, that will probably mirror what happens in this gold against the S&P. So I'll get more into that. So we'll turn more to precious metals now. So here's gold divided by everything. And gold against the stock market, what's really interesting, okay, so this is 0.46. So for this to go to 50 or 51, like a move to 51, that's a little bit more than 10%. If gold's at 25.50, that would take gold up to 2,800 without even breaking above this major resistance. So I'm starting to think that gold is going to get to 3,000 without needing to break above 0.50, because I think the market can continue to rally a little bit. I think gold will rally more here in the next couple months. But again, I don't think we're going to see a breakout in this until you have a real bear market in a recession. Everywhere else looks really good for gold. This move is being driven by, I don't want to say entirely dollar weakness, but we can see here, because this is gold against currencies excluding the dollar. And then gold in dollar terms is definitely stronger. So dollar weakness is definitely helping this move. Gold has already broken out against commodities. I mentioned that. So this is at, this is a 3.5-year high. And this is interesting. Gold against TLT and bonds, but this is looking like it could begin another leg higher. So that's really significant if gold is still trending higher against bonds. Certainly, if gold is not moving against the stock market, then we definitely want to see it moving against bonds. So in the kind of short term, we want to see it moving against one or the other. Last thing I want to talk about, this move based on the coming Fed easing. You have money going into stocks. You also have money going into gold. And, guys, I've babbled on about gold against the stock market so, too much lately that I haven't looked at this in a while. Gold stocks against the stock market. I remember when I wrote my first book, which is more of an ebook in 2015, gold stocks against the stock market, this was an all-time low. So this here, this means that this is an all-time low for gold stocks relative to the stock market. And so this gives me more evidence that the secular bull market, when I say it didn't really begin in gold until here or here. So this is a chart that supports that, gold stocks against the stock market. But here's a really interesting thing. This looks like an inverse head and shoulders here, an inverse head and shoulders bottom. Shoulder, head, shoulder. So you have, this is coming up to major resistance here. If this breaks out, the measured upside target is right about here. It's in the 0.009s. You can potentially see this make a big move higher over the next 2, 3, 4, 5 months. So this has a long way to run. That's all for this edition of Macro Mondays. Thank you so much for tuning in. And if you want to know which stocks I'm looking at, buying, researching, go to TheDailyGold.com, subscribe to our premium service. Thank you so much for tuning in, and I'll talk to you guys again later this week.